Good morning, everyone. So, going to take a bit of a step back here, talk about some of the themes, macroeconomic ones, industry-specific ones we're seeing across that are going to drive some of these commodity markets, which are, of course, all important for investment in the industry as a whole. I think it's very interesting. I think we're in an interesting market environment. I've had a lot of incomings this year from investors, particularly US-based investors, who have been negative on things, saying, look, we think the energy transition's over. We think China's done. Now, I kind of disagree on both those points. I will certainly talk about that in the coming slides. And I think the wider economic cycle isn't as bad as people maybe have thought, and particularly for metals. And at the same time, we have an industry which is still struggling to put capital to work on the whole. So these are the things we'll talk about today. I will leave a little bit of time as well at the end. So for those of you who don't know BMO, we obviously are a Canadian-based investment bank, Bank of Montreal. My job is just to do commodity analysis. Very proud to be supporting mining in Daba. Very proud of some of the stuff we do in this industry. Been voted best investment bank in metals and mining by Global Finance for 13 years in a row. We're sponsoring the Women in Mining 100 again this year for the 5th consecutive edition, so nominations are open for that. And also, if you want to hear my voice but not have to look at my face, you can listen to our Metal Matters podcast. That comes out every second week. Let's talk about the global industrial economy. It's not that bad. The US is remarkably resilient. In fact, I think the jobs data on Friday surprised everyone. Europe's struggling, and we're seeing the knock-on effects of the inflationary pressure that Europe faced. So Europe's not going to contribute much this year, but China's still leading the way, and India has been knocking it out of the park a little bit as well. And if we look at the lead indicators, they're actually all pointing positive in the key regions now. So the wider economic cycle is okay, and if anything, it's starting to improve. There's a lot of risk out there, and we'll talk about geopolitics in a minute. But from an underlying demand perspective, I don't think things are too bad. What we've had is a big destock. Destock isn't just been physical. Just that left-hand chart there looks at flows into commodity ETFs effectively through the course of the year. This is the first January in a decade where we've seen outflows from commodity markets in a January. That to me, there's so much money on the sidelines in the global economy at the moment. There's $6 trillion US sitting in money market funds. That will start to be deployed. And it comes down to the rate cycle, and when the US government might start to think to cut rates. We have the first rate cut coming through middle of the year. But some of that money, I think, will start to flow back into commodity markets, particularly if the oil price stabilizes. Ex-China, we're not looking for much. We're looking for an end to destocking. Because if you think of the past couple of years, if you had a credit line, didn't fund as much working capital as it did before, you're paying higher interest on it. As these rates get cut, people will start to at least stop destocking through value chains, which helps apparent demand for commodities. And maybe we might see a little bit of a restock come through. Not our base case, but that would be the upside risk from a demand perspective. So we're looking for a demand year that's maybe slightly sub-trend, but I don't think that's a problem. Talking about the supply side, and I'll get on to mine supply in a minute, but we're starting to see supply chain pressures re-emerge. That left-hand chart's an interesting one. That's the US Fed Global Supply Chain Pressure Index. And you can see what happened leading into Russia's invasion of Ukraine. So it went to the highest we saw in history, and then just 15 months later, it went to the lowest point in history. Logistics constraints were solved, and actually material was flowing around again. Now we're starting, of course, to see with the Red Sea situation, the Panama Canal is not operating anything like capacity. Actually, these supply constraints come back. Typically, that leads to bottlenecks in commodity markets. Typically, it leads to pricing going higher. And you can just about see it on that right-hand chart. You can see that global container shipping index, not surprisingly, is starting to head up pretty rapidly. What does that affect? Actually, ferrous scrap of all the markets I cover is probably the one that has most impact here. But also base metal premiums will likely go up, certainly in Europe. We're seeing things like chrome ore, coal shipments also facing some longer routes. So I said before, I was getting all these incomings about China not being great. it's not what the data says. For commodity markets, China's still the most important economy, will be for a long, long time. And look at the fixed asset investment. Now, you can see one negative, real estate. China property is a problem. It's still an overhang and sentiment for the global mining industry. But everything else is doing very well. Look at some of those. I mean, Chinese manufacturing is doing well. Big investment in electricity, of course, which we'll certainly talk about. And then you look at the commodity trade. So global trade fell last year. China's calling commodity markets didn't. If you look there, some big numbers in terms of, I mean, thermal coal, big commodity. Huge gain in China's imports last year. Even some of the smaller ones around zinc, nickel, you saw more than a 10% rise in raw material imports. This is part of a wider trend. China's still securing raw material supply, and I will talk about that a little bit in the coming slides. So the other headwind that people were talking about, energy transition. Energy transition is doing fine. We have a market share battle in the global energy transition. GM and Ford can't sell as many cars as they would like to because they're behind in technology and they're behind in economics. BYD is the biggest electric vehicle car company in the world now, overtook Tesla last quarter. It's a market share battle which is being led by China. But what you see when you have a market share battle, costs come down and actual penetration rates go up. We have been upping our numbers for electric vehicles. We have actually been upping our renewable energy installation expectations. One interesting thing you see, China is now the world's largest automotive exporter. It's usurped Japan in recent times. Some of that is electric vehicles, some of it's just more traditional internal combustion engine vehicles. But you're starting to see that get the raw material. So this model that China's had in commodity markets, get the raw material, process that, export the commodity product. And now you're starting to see it move into much more into these capital goods and manufacturing type segments. Global, I mean, if you look at the left-hand chart, it's quite ridiculous. China installed close on 300 gigawatts of renewable energy last year. That's a phenomenal number, very metal-intensive spend for renewable energy. Actually, it's going too fast. We actually have it coming down a little bit this year because effectively China's grid cannot cope with the amount of distributed solar power that's being pumped into it at the same time, running into capacity constraints. So what does that mean? You have to solve the constraint. China's grid investment will remain very strong this year. It will be into distribution networks to up the capacity there. It will also be into energy storage, which surprised also on the upside in terms of the battery industry last year. So we still see a lot of metals intensive spend coming through that Chinese economy over the course of this year. Now, I'm talking very positively here about what China's been doing in markets. There's some problems. I worry a little bit about the quality of loan books at the Chinese banks because they have been lending into sectors that have been struggling. Now, not all of them, but if you look at the bottom two on the left, why was China's industrial profitability so low? Mining sector's not great, and neither is the coal industry. So there may be a little bit more pressure there. It's interesting, if you look at the Chinese coal industry, it's actually more enterprises there lost money last year than they did in 2015, which is when the Chinese government effectively came as close to panicking as I've ever seen and implemented the 276-day working policy to try and reflate the coal industry. So at some point this year, we might need to look out for some push for consolidation in the Chinese downstream industries, and it will probably come from the financial sector, which means it's very hard to call the actual timing on it. But there has been arguably overinvestment in a number of areas, and it's not just it's not just the obvious side. It is, wind turbines, it is solar panels. It's all these other things where you're going to have to see, as I say, a little bit of capacity management over the course of the year. So the underlying demand trend isn't altered by that, but it does mean that we could see a few more strains in that Chinese energy transition related sector and indeed some of the old school sectors like coal this year. Okay, critical minerals, big topic. And as I said there, a problem with China and a problem for China. Because we all look at it from one way, quite rightly, in that, yeah, we need to diversify the dependence on China in global value chains. And particularly for processing of metals and indeed a lot of the energy transition goods. You see that, I mean, China arguably has started to weaponize critical minerals a little bit more. Of course, gallium, they did not ban exports of gallium and germanium, they just made it very hard to do so. So what happened? Suddenly we've seen gallium, where China's 93% of global supply, and the exports are falling. That's creating constraints. That is the sort of thing, you've seen it happen with graphite as well more recently, so we'll have to see the impact on that market. But then, China has its own problems. If you look at it, China's got heavy reliance on ore imports in a number of areas. So if you look at it, import share in total consumption very high for a lot of the key metals we might look at. And actually, often that's on one supplier. So nickel from Indonesia, historically cobalt from the DRC, bauxite from Guinea. So there's a lot of, China's running its own risk in terms of concentration risk. So what do we expect? We expect some management and some, to try and go and diversify those sources of ore supply where possible. But critical minerals are, it's the battle for global raw materials is only starting to pick up. And we are now starting to see the funding coming through. Now, it's taking a while, but it is interesting when you've got establishments like the International Energy Agency is now starting to get a lot more involved. They've historically been an oil-focused agency, but now they do recognise that this is where, say, the next battleground, if you want to think of it that way, is coming from. I think a lot of countries talk a lot about critical minerals and come up with policies and create lists, which can take a long time. I argue China's while everyone else has been talking, China's actually been putting some action. To me, this is interesting. China's outward direct investment in mining, second highest on history, we think, last year, and probably going to be the highest this year. Where's that gone? Yep, a lot of lithium in Africa that in many, for commodity analysts, I would argue it almost came out of nowhere. But you see there, you had the big peak going up to 2014, and then you had, maybe some of the projects overseas didn't work so well. You had a big pullback from the Chinese banks. But now we're starting to see that really pick up. At the two sessions meeting in China last year, raw material security of supply was number 5 in the agenda. That's the highest it's been, again, in a decade since we saw that last push. And it's not just in the overseas economy. Just to flag, fixed asset investment in non-ferrous mining in China domestically rose by over 40% last year. That's, again, the highest growth rate we've seen since 2007. So we are starting to see a lot of Chinese money still put to work in the raw material side to try and address some of those potential bottlenecks and constraints that the Chinese economy faces. Well, I would argue with critical minerals, everyone knows now kind of what they've got, and the question now is, can we see value added to it in jurisdictions? Essentially, I've just used the White and Case survey that came out last week there. What do you expect to be the most common responses of mineral exporters to growing market and geopolitical pressures? And that's to try and push for investment in the local industry and to add more value. There are some precedents. Indonesia's done it pretty well. If you look at that right-hand side, that's Indonesia used to ship nickel ore to the market. Then it started to ship nickel pig iron following Chinese investment. Now we are starting to see a bit more stainless steel come through. And Indonesia wants a battery industry. That's going to be the next push. So I think that will be used as a precedent for many other jurisdictions who are, blessed geologically to try and get some more value into the economy. Now, getting that right is hard. Indonesia are very fickle policy, moving all over the place. Consistency is much more what's needed to get the capital put to work. Indonesia benefited from Chinese capital. I think you will see, when you see more developed world capital come into other markets, it will need a more stable jurisdictional backdrop. Global mining capex, though, where's the positive and the negative? The positive is, it has been picking up. But if you do that on a cost-adjusted basis or an inflation-adjusted basis, it's not really. We have seen capital cost inflation come through pretty aggressively. So mining expansion capex, back above $100 billion. But I would argue on a like-for-like basis, that's still well below where we were a decade ago. And I do think we have, particularly for the large major diversified miners, you have a very conservative batch of CEOs at the moment. And there's reasons for that. What's likely to attract, again, it's another white case one, what's likely to attract institutional capital into the sector? Shareholder returns still number one. If you're a mining CEO at the moment, you could do a capital project that might or might not return your capital in 10 years, which is beyond your tenure, or you can give shareholders money now, and you can be rewarded for that. And the equity markets are still rewarding shareholder return. So while that is still the case, you don't get as much capital put to work on growth projects. And I'd love to say we're going to see it pick up this year. I'm not sure we are. I still think shareholder return in a world of high geopolitical risk will be in focus. It's also quite hard to put money to work when, well, that left-hand chart is just showing the year, basically year-on-year change in commodity prices. Now, uranium, of course, is the standout in terms of the positive side. Pretty much everything else, ex-gold, is down on where it was this time last year. So you've got a falling commodity price environment. Again, when commodity prices are falling, it's hard for people to say, oh, actually, this is a good time to go and invest in the sector. And I want to talk about this right-hand chart just for a minute. It's a copper. Everyone loves the copper industry. That's a historical incentive price curve, i.e. looking back and saying, well, if a board had known everything about a project when it actually made the decision to approve it, what sort of incentive price would have been needed to make a 15% IRR on that project? And basically, at today's copper price, which isn't a bad copper price, half the projects delivered by the mining industry in the past decade would be loss-making. Capital blowouts, problems, but if you're a CEO and you see this, you go, Jings, either I want a higher hurdle rate or I'm just not going to take the risk. This is just too hard. And this is why we're not seeing the capital put to work. Now, it does mean that there is a place for more entrepreneurial companies who can raise money and get some capex to work, and they will eventually move up the value chain into the big guys. But for now, we're still not seeing enough capital put to work to match supply and demand. But it does mean things have to adjust. I just wanted to, we were doing a little bit of study looking at what I would term Chinese versus more traditional capex. And it's just the evolution in Wood Mackenzie's supply forecast over time. Now, the left-hand side is nickel. Chinese money. China investing in Indonesia, consistently being revised higher in terms of the potential. Now, nickel demand has also been revised higher because of stainless steel demand, because of batteries. But you see on the supply side, supply has consistently surprised on the upside. So we have an overcapacity problem. Right-hand side is copper. That's the opposite. We just have not seen the copper industry grow at the pace it was meant to. And you can see there, I mean, you could argue that's relative to potential, and that's about 10 million tons of disappointment in terms of the supply side. So that keeps us still quite resource constrained in that industry. But it's interesting to see the different dynamics. Where Chinese capital has been put to work, we've been surprised on the upside. Nickel there, lithium last year, I would argue. Whereas in where we see more traditional capital spend, it has actually disappointed. I've talked about China a lot in this presentation, but of course now we are starting to get questions on India, and quite rightly. I mean, India is, as an economy, getting its act together. It's amazing what you can do if you get money in the banks, and the banks can then lend. But you can see, I've just compared China and India's contribution to copper, or you could do the same for any commodity, over the past 50 years. And you can see there, it's been dominated by China, and India's been this little bar. But you look on a go-forward basis, and actually India does now justify being part of the conversation, second largest consumer in the world for many of the commodities that we look at. And it's got a long way to go. I mean, that right-hand side, steel capital stock, you can see there that China's actually getting pretty close to US and Japan in terms of steel installed in the economy. India's that green area at the bottom, a long, long way to go there. And India's always had potential, still has potential, but you would argue that it is being realized a little bit more over the past couple of years. Coming back a little bit more near term, we do need to see supply cuts in a number of these areas. As a commodity analyst, I like to see supply adjustments to try and bring things back towards balance. The quicker you get supply cut, the quicker you reset the cycle. If you have to wait for demand, it can take a longer time to come through. Nickel, yeah, oversupplied by 200,000 tons, which is, I mean, kind of 7-8% in the market last year. We are now at a point where you're starting to see strategic reviews, which is fine, but you'd want to see more strategic cuts coming through to try and balance the market. You can see actually on the right-hand side, that's prices versus the 90th percentile, where they were at the end of the first quarter last year. where they are today, and you do see that some of these commodities are starting to trade into the top end of cost curves. And I'd say that just needs a short-term decision-making to say, well, actually, is it worth extracting at the current time, or can I hold this back? Always a hard decision to make, but I think there's still confidence about the long-term demand dynamics, but that doesn't mean producing at a loss is a wise thing to do. Just going to talk a couple of commodities, copper and gold, just to finish off here before I open up for questions. I remember this time last year, I was standing up here and I was kind of talking down the copper market a little bit because the price is above $10,000 a ton, and I couldn't justify that from a fundamental perspective. Fast forward now, the copper market's as tight as I've seen it in a long time from a raw material side. Those treatment charges there, you can see on the left-hand chart, they're actually lower now. That's telling you there's no copper concentrate available. Smelters are bidding down on copper concentrate to try and keep their facilities going. If you're a smelter and you're paying 20 on the treatment charge and 2 cents a pound on the refining charge, you have to be pretty convicted the copper price is going up, because that's the only way you're making the economics of that work. So I think people would then say, well, why aren't we seeing it in the refined copper price yet? You will post-Lunar New Year. At the moment, this is the weak demand part of the year, seasonally. As soon as we come out of Lunar New Year, you will start to see Chinese demand come through. And that's when that refined market, the concentrate market tightness will flow through into refined market tightness. So the long-term demand story for copper has always been good. I think short-term, we are facing a little bit of a supply constraint at the current, a big bit of a supply constraint, arguably at the current time. We've taken basically 1 million tonnes of mine supply out our copper expectations for 2024 since the start of October. Scope Panama, that is downgrades to Anglo-American expectations. Udokan in Russia, the fire there. But that is a lot of supply coming out of this market, and I think that will be noticed increasingly over the coming months. Now, of course, commodity markets look after themselves. I mean, I've said it many times, I'll say it again. If the price goes too high, what happens? You get thrifting, you get substitution. This is the natural way of economics. We did a big look last year about where could we see copper thrifted and substituted from if things were to get tight. And by the way, this only happens at the right price. It's interesting, we're starting to see a lot more in air conditioners, particularly on the commercial side. So you're seeing a lot of air conditioners switch to aluminium. Again, I'm saying commercial because it has to be where you're not space constrained. An aluminium air conditioner can take up 4 times the space of a copper one. The other interesting one is actually on the electric vehicle side. Now, we used to say electric vehicles are 4 times as copper intensive as an internal combustion engine. Now that's 3, and it's probably coming down a little bit more. And I think that's just a natural part of the process. The first electric vehicles were over-engineered. They were proof of concept, they had to work. Now the auto industry is getting better at removing things, and copper is just one of them. So to me, it's what we actually need to see to try and balance the market in the medium term. But it obviously does hurt the wider thematic because this was meant to be a fast growth area. And just a couple of words on gold to finish off with here. Gold's still very important to the mining industry as a whole. The correlation with real rates broke down, probably end of 22. What is the gold price correlated with? Interestingly, Chinese households' willingness to save. If you are a household in China at the moment, where do you put your money? Because the equity market is diabolical, the bond market's nascent, property market used to be your go-to, but the property market isn't good either. Gold's still been offering a return. So actually you've seen that kind of micro asset allocation push towards gold. It means actually probably the biggest risk to gold price this year is a Chinese equity market rally. We're not seeing signs of that yet, but there's something to watch out for. But you have this interesting dynamic of the kind of tops and tails of the gold market. You've got the central banks who are quasi-annuity buyers now. The push to de-dollarize and diversify holdings will continue. Arguably, you've got 2 fiscally irresponsible candidates for the US presidency, which will therefore put a little bit more pressure on the dollar. But and then the other side is say you've got this Chinese money flowing into the gold markets through wealth management products. So I think that's an interesting dynamic that hasn't been talked about as much in the market. We're used to talking about China for industrial metals, increasingly important for precious metals as well. Just the last thing I would say, from everything I've said, look, long-run prices are still being moved higher. So short-term prices in commodities can be flipped up and down. They flow with the short-term cycles. The long-run pricing's been moving up. So we've moved up our long-run prices by more than 20% in many cases over the past few years. And I still see a trend where expectations for what a through-cycle norm will be have to be moved higher, partly because of capital costs, partly just because of tighter market balances than before. Interested to see how steep or how much some of these cost curves have actually moved since the start of the century, since the China boom started to come through. With that, I think I've left a few minutes for questions at the end. Happy to take any questions that you might have across any individual commodities or markets in general. Thank you.
Thanks. Actually, yeah, after your talk about Chinese property, why is it the demand for iron ore is so strong and the price has stayed so high? I mean, is that an anomaly? Is this going to be a year when iron ore comes down?
We don't have growth in iron ore this year. We do have. I mean, iron ore is not a growth market generally. Chinese steel production has more or less peaked. Now, two things. China basically fudged the data a little bit last year in terms of the steel production. At the end of last year was much stronger than actually the official reports. That supported iron ore. Secondly, steel exports. So we previously were factoring maybe 40 million tons of steel exports from China. Last year that was 95. And every ton of steel produced in China is that bit more iron ore intensive than one produced elsewhere. So what you've actually seen is this Chinese fixed asset investment push into other jurisdictions, mainly around EPC or infrastructure style projects. So where was that steel going? Indonesia to build a high-speed railway. Again, a Chinese EPC contract. Ethiopia to build a dam. That's where the Chinese steel was flowing. So iron ore, I like the high-grade iron ore market. I'm a big believer in pellets. I think pellet feed will become a separate iron ore market quicker. But for on the whole, it's not a growth industry in the longer term. We have the price holding above $100 through most of this year, but longer term we do have it edging a bit lower.
Yeah. And then on the other big ones, you mentioned nickel and copper. I mean, do you think that's going to continue? What you said, that nickel supply will creep up more than expected, copper will remain tight. That's going to remain true, is it?
I think so. I mean, if I take both in copper, of course, I said we're taking things out for 24. We've kind of pushed some things into 25. And so we have Cobre Panama coming back. Theoretically, you could see a bad year for copper in 25, but we've said that about 24, let's be honest, and it's tightened up. In terms of nickel, a lot will actually depend on the Indonesian election that comes up June this year. We'll see if that changes any policy. We're already seeing Indonesia saying, no more MPI plants. We want to build MHP plants. We want to build HPALs. We want to push for the battery type sector. So I think the pace of growth will slow, and obviously economics will dictate that it will also slow. But we do see enough capacity in that industry at the present time. I should also say that if we think of a battery technology, we've been increasing the nickel-free, so lithium iron phosphate chemistry, and pulling back a little bit on the nickel-rich chemistry. It's just the way the auto industry is moving.
Do you think you'll see nickel supplied in the United States?
Do you
think nickel supplied in the United States will, at any point, be given a premium status? National security grounds, etc.
I think that word premium. As soon as you say that word premium and you're a customer, you go, I have to pay more. I think premium is. I'm a believer in responsible sourcing becoming a qualification over time. And that will mean that part of that will be carbon, part of that will be traceability of product. Does that happen quick enough to get investment? I think there's a push to try and get material going. But if you look at the Inflation Reduction Act, only 3% of that money's been put towards mining. So, and yes, as we heard before, there's a big US delegation down here, but I don't necessarily think that will transfer into domestic sourcing. It might just try to be a bit more overseas security of supply. A security of supply is a big issue. It's not driving the investment we kind of maybe thought it would this time last year. Oh, so silver, okay, yeah, interesting. Interesting. So silver, the demand side for silver has been pretty strong over the past couple of years. I think silver will have a run at some point. Silver's still a very retail-driven market. The new solar technologies that are coming through, heterojunction, TopCon, are more silver-intensive than your traditional cells at the moment. And at some point, I think the market will start to talk about that a lot more. So the trend of thrifting silver in the solar industry starts to reverse. So you not only have installations being strong, but you actually have silver per cell going up as well. I think that will be a very strong story when it comes through. Hard to call the timing as to when that might be. Otherwise, silver's intrinsically still linked to the gold price overall. Will not break out from that. The thing about, silver into the solar industry is only about 13% of demand at the moment, but it gets levered through the ETFs. And that's when you would start to see it perform. So we do have the gold to silver ratio falling slightly over the course of this year. But we do have silver breaking out on the upside. Wonderful. Well, thank you so much all for your attention, and enjoy the rest of your conference.